All right, let's get started. Hi, everyone. My name is Richard Robinette. I'm a partner here at Crowdfunding Lawyers. We are a securities law firm that deals with raising money using securities exemptions. A lot of real estate companies and medical companies and car washes and other types of businesses that need to raise capital, mostly equity capital from investors. We help them do that legally, prepare all the legal documents, guide them in how to talk to investors and things of that nature. That's our business. It's what we do. And so glad that everyone joined today to talk about one of the ways that we set things up, which is called Regulation A. Regulation A has gotten a lot of buzz. It's fairly new. It only really became usable for the large part in the last 6 years or so. And they've actually made some changes to it just recently that make it even better. So we're going to get into all the ins and outs of Regulation A and whether it's right for you, and if it is, exactly how you do a regulation offering, what you can expect along the way. So I hope to make this informative, if not entertaining. I know it's dry subject matter. I do the best I can, but let's just dive right in. So as we always have to do, we are attorneys, and attorneys do disclaimers. So here's my disclaimer. This is not meant to be legal advice. You are not watching this video as a client. If you were, you'd be paying a lot more for it. This is just for your information and enrichment. Please, please, please talk to your own professional advisors, attorneys, CPAs, etc., before you do any kind of fundraising or any kind of investing in private securities. So, and hopefully one of those professionals on your team ends up being us. We would really like that. But if it's not us, please use somebody. Don't do this. Don't try this at home, kids. All right, so let's come in. What is Regulation A? So Regulation A is an exemption from having to register securities with the SEC. It is a way of doing what we call unregistered offerings or private offerings. Now, you'll hear it called Regulation A. You'll hear it called the mini IPO. They made a change 5 or 6 years ago that improved things. So people have started unofficially calling it Regulation A+. When you hear Regulation A, Regulation A+, it's the same thing. They just updated it again and made it a lot better back a few months ago, depending on when you're watching this. So some people are even calling it Regulation A++, and who knows how many pluses we'll end up with. I'll for short call it Reg A, not to be confused with Reg A, but yeah, sorry. Okay, so here's the scoop: is selling securities ever since we had the stock market crash in 29 and it kicked off the Great Depression. Congress, in its usual knee-jerk fashion, overreacted, in my opinion, and just basically banned selling securities altogether, and then licensed the right to sell them back to people, in the hopes of protecting investors from a lot of the shady business that went on back in the 20s. So the Securities Act of 1933 says all securities offered in the United States must be registered with the SEC and applicable state securities regulators. Registration is a super long process, super expensive process. It doesn't make sense for smaller type of deals. You're talking, you're under 100 million or something. It's just like registration is a very expensive way to go. Or you can qualify for an exemption. And the exemptions essentially mean as long as you don't do what's considered a public offering, and the SEC has created regulations that outline things that we're not going to deem public offerings or things that we're going to exempt from the requirement to register. Okay, so some of the common ones you're going to see, and the absolute granddaddy of them that everybody uses is called Regulation D. And the biggest rule relied on under that is called 506B. Literally 99% of offerings end up being 506B. 506B and all of these have some pros and cons. So under 506B, you can raise an unlimited amount of money, but there's no public solicitation allowed. In other words, the people that you raise money from have to have already been in your personal or professional network. There's no getting on Facebook and Instagram and finding strangers to come invest in your deal. So there's one downside. The other downside is you're limited on how many unaccredited investors you can have. Now, if you don't know what an unaccredited investor is, check out some of our other videos on our YouTube page where we talk more extensively about that. In a sense, or just to oversimplify, accredited investors are basically rich people, or people that have high incomes, $200,000 or $300,000 a year, or net worth of $1 million or more, not including their home. There's a lot of people who are millionaires, but most of their assets are their personal home. Personal home doesn't count. So you people that have $1 million in addition to their home. So we're talking, depending on what statistics you rely on, 5 to 10% of the US population is accredited. So very small percentage of the population is considered accredited. In a 506B offering, you can only have 35 unaccredited investors brought into a deal every 90 days. So it limits your investor pool. Okay, so that's 506B. There's also 506C, another popular option. Again, unlimited offering amount, which is great. It actually allows public solicitation. You can get on your Instagram, your Facebook, and everything and say, hey, everyone, I got a deal, come invest. But no unaccredited investors. So your investor pool is restricted just to that 5 or 10% of people that qualify as accredited. Then there's regulation CF, or regulation crowdfunding. And this is another fairly new exemption that we're allowed. It allows you to raise money online. You can publicly solicit, and unlike regulation D offerings, anyone can invest in a CF offering. There are limits on the amount they can invest based on their net worth or income, but everyone can get in, at least for a little bit. But your overall offering amount is limited to only $5 million. And this $5 million is actually a huge increase from what it was last year, which was 1.07 million. So they significantly increased it, but still $5 million when you're talking about commercial real estate, or you're talking about medical devices or whatever, that's in the grand scheme of things, it's still a very small amount of money. So the usability of CF is limited in that sense. Okay, so that brings us to Regulation A. And Regulation A takes care of a lot of those red frowny faces we had on the previous page. So Regulation A it's not unlimited, but it has a high offering amount of, you can raise up to 75 million. Now, if you Google Reg A, a lot of the stuff that you're going to see come up is going to say 50 million, and that's because they just recently raised it to 75. You can publicly solicit, Instagram, Facebook, all that. Just go advertise, make billboards, do TV ads, radio ads, who cares? And again, anyone can invest. So like the CF, but with that much higher total offering limit. Now, again, if you're unaccredited, you are limited, or if the investor is unaccredited, they are limited to how much money they can put in as a percent of their net worth or their net income. So as an investor, you cannot invest into any one deal more than 10% of the greater of your net worth or your income. And in my opinion, that's a reasonable rule, because frankly, nobody who's unaccredited ought to be investing that big a chunk of their nest egg. I mean, 10% is more than a month's pay if you're going on your income. And 10% of your net worth, imagine taking 10% of your assets and setting them on fire if a deal goes bad. Like, that's not great. So unaccredited investors frankly shouldn't be investing much more than 10% of their net worth in any given deal anyway. So I think it's a reasonable restriction, but it is a restriction. Accredited investors can invest as much as they want. Okay. Now, downsides of Reg A, one is it has a much longer timeline. It takes longer to actually get your offering to the point where you can start bringing in investors and accepting their money. You should plan on at least 3 months, possibly 6 months. I've even seen deals go longer. I've seen them go on towards a year for various reasons. So it's not something where, oh, I need to raise money tomorrow, let me put an offering together. Reg Ds and Reg CFs are going to be much faster than the Reg As. And the next downside is just a sheer expense. As you're going to see, as we talk about this throughout the presentation, this is actually submitted to the SEC, and there's some back and forth that just simply takes time. It takes a lot of attorney time. It's a much more extensive offering document than we use in other exemptions. So there's a real cost to doing Reg A. So that's the other downside on it. So given all the pros and cons, let's talk about who is this for. And the people that Reg A seems to be appropriate for: one, people who need to raise a large amount of capital. So $5-10 million deal, this is probably not where you want to be. Again, that expense is really high, so you're going to want to get a lot of bang for your buck if you do it. This is for people who are good at marketing. You are good at going out and getting attention. And people who already have a large public following. And when you're followed by the general public, it means you're generally followed by unaccredited investors. So you have a large group of unaccredited investors at your disposal for you to pitch your offering to. People who already know who you are, people who trust you. Nobody like me, if you go out with a Reg A, I'm not going to have a very good time because my social media game is terrible. My marketing ability is terrible. But if you've got the skills, this may be for you. So, think about, how good are you at getting attention on Facebook, on, Reddit, Blogger, WhatsApp, YouTube. Is that Tumblr? Yeah, I think that's Tumblr. We won't talk about MySpace. Twitter, Instagram, Snapchat, TikTok, LinkedIn, all these different social media. If you are good at attracting eyeballs, and the people that you attract, you think are likely to be people who would put money into one of your projects, then this may be the avenue for you. So, doesn't mean you necessarily have to be, Kim Kardashian or Grant Cardone, both of whom have serious social media game. I mean, you can be this dude who just points out obvious stuff and has 50 million people following on TikTok. You seen this guy? Anyway, find him. He's funny. His name's Cabby Lame or Lame, I guess. Anyway, funny dude. But anyway, so you don't have to be like the Insta influencer or whatever, but you do need to be someone who can get attention through marketing somehow to make this work. All right, this is not for the faint of heart. And probably not for the newbies. If you've never done a securities offering before, Reg A may not be where you want to start. And the first thing is expense. As I discussed, you're going to shell out a lot of money, one for your securities attorney. You're going to need an auditor. You're going to be paying technology providers. You're going to be using a securities escrow account, which has significant fees. And you're going to spend a ton of money on marketing efforts. So expect to put in between $75,000 and $100,000 start to finish to do your Reg A offering. The other thing I discussed is time, 3 to 6 months to go through the entire process. And then volume of investors. Reg A offerings tend to be offerings that bring in a larger number of investors than, say, a Reg D offering. And more investors means more paperwork. It means having to put out more K-1 reports at tax time. It means fielding more investor questions. And then generally, you're going to have smaller net worth investors than you're going to have in the Regulation D offerings because of who you're targeting. You're targeting the general public. The general public has smaller net worth and smaller income than the small pool of investors that hang out in angel investor clubs and investment organizations and stuff. And not to knock on people that don't have a big income or a big net worth, but the reality is that smaller dollar investors tend to need more love and care. And it makes sense if you think about it, because the guy that can only scrape together $5,000 to invest in a deal is putting up a much larger portion of his life savings than the guy who can drop $50, $100, $250,000 in a deal. The guy throwing $250,000 in your deal probably has that covered 50 times over, whereas the guy putting 5,000, that's probably the only money he can spare to do any investing. So he's going to be a lot more, concerned about his investment than the guy that's dropping the big dollars. And if you're gonna rely on Reg A and you're gonna rely on this kind of social marketing, crowdfunding of your deal, you're gonna have a lot more of those people with smaller relative net worths. So I found this thing on the internet about the difference between low dollar clients and high dollar clients and how they treat their money, and it's really true. It's really true. So be prepared to deal with investors that are going to have more questions, more concerns, that are going to hold your feet to the fire a little bit more carefully, because even though they have less money in the deal, they've got more to lose. Okay. So if that hasn't scared you away, and frankly, when I take consultation calls and people call me and say, I want to do a Reg A, the first thing I'm going to do is test them and see if I can talk them out of it, because it is a very small group of people that really ought to be doing this, as opposed to using some of the other offering methods. But if you pass my test, if you can stand up to the onslaught of questions I'm going to get you, then we're going to go forward and let's do your deal. So let's get into the nitty gritty. The maximum offering amount, as I said, $75 million. This is only for United States or Canadian issuers. This means that your entity is formed in either the US or Canada, and your principal place of business is in the US or Canada. So you are local to this area. No SPACs. I get calls all the time about SPACs. SPACs are the hot thing right now. Everyone's talking about them. A SPAC is a special purpose acquisition company, basically a shell company that doesn't have any business plan at the moment other than to collect a whole lot of money. And usually the idea is they're going to buy out another company or merge with another company in the future, but they haven't named that company yet. They haven't really established exactly what they're going to do. They're basically just saying, give us money, trust us. No SPACs allowed under Reg A. No investment companies or business development companies. So these are companies that are dealing primarily in securities, that are buying other securities. So no funds of funds allowed in Reg A. We're raising money that's going to fund businesses and buy assets. They're not going to be buying other securities. If you need to know what security is, check out our how to structure syndication video up on our YouTube channel. Subscribe, like, hit the bell, all that fun stuff. And then no undivided fractional interests in oil and gas. So we're not pooling money to do oil and gas under Reg A. All right. Important thing when you're doing your Reg A offering is you got to get your team together. So primary player, and maybe a little self-interest putting this first, but you need a securities attorney. You need a securities attorney. You need a securities attorney that has done this before. This is not your uncle that does wills and trusts. This is a securities attorney. Broker dealer, you should have a broker dealer. Some people do Reg A offerings without broker dealers. I think it's a bad idea. For one, there are 7 states, the quote unquote problem states, that flat out say, we require you to have a broker dealer. We will come after you if you do not have a broker dealer doing Reg A. Reasonable minds can disagree whether those laws or those regulations are federally preempted. But I don't know about you, but I don't want to be the first person to have to go to court and win that fight. So the safest bet is to just accept that, yes, these states can require a broker dealer, and I'm going to use a broker dealer at least in these 7 states, if not in all states. And there's a lot of broker dealers that'll say, okay, we will lend our broker dealer services or compliance services nationwide for 1% of whatever you raise, or we will do it just in these select states, but we want 3% of what you raise in those states. So up to you whether to use a broker dealer or not. I recommend it. You should use a broker dealer. You're going to need an auditor. The financial reports that go into your offering must be audited. Again, not cheap, but you do need to get an auditor to get them early. And even if is a brand new company, hasn't done any business yet, you still got to have an audit. I mean, they're auditing nothing. They're looking at a bank account that has 2 expenses, a securities attorney and an auditor. Those are the only 2 things that go on the expense report, right? And that's, the money you contribute, to get that started is on your balance sheet, and that's the whole audit. And then they have notes to explain that that's the whole audit, but you still got to have it. Transfer agent, the transfer agent just manages the investor accounts and keeps track of who's bought what shares, who's sold what shares. Very, very useful. A compliance service that handles your regulatory filings, your blue sky filings. And blue sky filings in Reg A are a lot different than blue sky filings in Reg D. Reg D is super simple. You take an investor money from a particular state, you have 15 days to do a notice filing in the state that says, hey, I did an offering and I took money in your state. On Reg A, a lot of these states, they want the notice before you take any money, before you make any sales. They want you to predict the future and say, how much money will you raise in our state? And let us know 3 weeks before you raise any. So it's very difficult to comply with, very technical. Using a third-party compliance service that does nothing but these kinds of filings is super helpful. And then you may or may not want an offering platform. So there are Reg A platforms out there. They're just websites. They're websites that will present your deal to investors. Investors can go to the site and look at your deal and a dozen other people's deals and decide what they want to invest in. They host all of your documents and let people make their investment decisions. And then securities escrow. So you need a bank. This is not, excuse me, like a title company escrow. This is a bank that has a securities escrow account for securities offerings. You expect the fees on this probably in the neighborhood of about $4,000 or $5,000. But that's where your investor money is going to go when they initially contribute. And it's not, until you raise your minimum offering amount where you're allowed to use the offering, the money's going to sit in that escrow account. Okay. One of the cool things about Reg A is they give you pretty broad latitude to test the waters. And that means you can today, like right now, you can go and start communicating with investors to gauge their interest. Hey, I'm thinking about selling shares in my company. I'm going to sell them for $1,000 a piece, and we're going to buy this building, or we're going to do this business or whatever. Would you be interested in that? That's testing the waters. Now, you have to disclaim a little bit, or you have to clarify. One, we're not taking any money right now. If you send me money, I'm going to send it back to you. I can't accept it. I'm only trying to get your interest. I just want your name, your phone number, your email address, and whether or not you might invest in something that looks like this. I'm not making any offer to buy. If you say, yes, I'll buy, I can't accept that. I can't hold you to that. This is not an offer, and whatever you say to me doesn't matter. There's no commitment or obligation to actually go through with buying it. So again, just dipping my toe in to see if people might want to invest in my widget company. And if I get a lot of interest, then maybe I'll go forward with my Reg A offering. And if not, then maybe I'll do something else. Now, once your offering statement is filed, and we'll talk about what goes in the offering statement, but we're going to have a big, long document we file with the SEC. Once it's filed, any testing the waters communications I make have to include a link to go read the offering statement. So I give them a URL, or I just include a copy with my communication, or I at least give them information on who to contact, where to find them, so that they can get a copy themselves. And then when you file, any testing the waters communications that you made beforehand, at least written ones, must also be filed along with your offering statement, meaning the communications you make to investors, the emails you send, the Facebook posts, and the Instagram ads you make are all going to be seen by the SEC. They're all going to be made public. And that's very important, because you got to make sure what you're communicating is truthful. You're not misleading anybody. They actually consider it an offering of securities for purposes of anti-fraud provisions. So if you lie to somebody in your testing the waters materials, you can be held accountable for that as if you lied selling them a security, even if you never sold one. So anyway, so just know that whatever marketing that you send out before you file your offering statement is going to be made as public record and scrutinized. All right, so the offering statement. The offering statement is also called Form 1A, and this is what we file to do a Reg A offering. The Form 1A starts with just basic information about the issuer and the offering, how much money we raise in, what tier under the regulation are we using, etc. It includes an offering circular. Those of you that have looked at Reg D deals before will have gotten a PPM, a private placement memorandum, or if you've done other types of investments, you may have gotten a prospectus. Same kind of thing. It's just a really long, boring document, cure for insomnia, that just has details about the offering, an endless list of risk factors. Here's all the ways you're going to lose your money. Don't say we didn't warn you. It's going to have the business plan. It's going to tell you the expected use of proceeds. It's going to have the bios of all the officers, the sponsors, and management of the deal. It's going to have a copy of the audited financials. So we're going to have the balance sheet and the income statement and all those reports, along with auditors' notes about the company, the performance of the company so far. It's also going to contain dire warnings that if the company doesn't raise enough money, it may not be able to continue. Sign here to put your money in. And then it'll have exhibits. So the formation documents of the LLC or the corporation, the governing documents, so your company agreement, your bylaws, the things that govern the relationship between the investors and the managers. It's going to have the subscription agreement. So this is actually the document you will end up filling out if you do want to invest, or if the investor wants to invest. Material contracts, so contracts with their third-party providers, contracts with their broker dealers, contracts with their GCs and other people, anything material, the agreement that the company has entered into. Your testing the waters materials are going to be included right there for everyone to see. And then some miscellaneous other documents, legal opinions, tax opinions, auditor certification, things of that nature. So all of that's going to be included. Very, very, very long, tedious. It's very, it's a lot of work to put together. It takes a lot of time. It's much more voluminous than what we normally see in like Reg D or Reg CF offerings. But that's in a nutshell what's in it. So then there's filing. So filing has to be done electronically. We send it to Edgar. Not that Edgar. Edgar is the electronic data gathering, analysis, and retrieval system. It is what the SEC uses to accept offerings and also puts them on, makes them available to the public. So you can search on Edgar for filings made by any company that's done Reg A offerings, Reg CF offerings, public offerings. It's all there. It's called Edgar. So that means the documents have to be formatted a particular way. I have no idea how to do it. We use a third party that we just send to, and we're like, hey, please Edgarize this, and they do all the work and ship it off to us. So it has to be in special XML or whatever formats. I don't get all that technical crap, but that's how it has to be done. So no paper filings, no faxes. Okay, once you have filed, then you are going to go into a process of responding to comments. Plan on you're going to get comments. So you're going to submit your Form 1A, and then within 27 days, you're going to get a comment letter back. And the comment letter is going to have questions from the SEC. They're going to ask you to explain things, remove things, clarify things, reword things, whatever. They're going to pick through your document and tell you things they want you to change. So common things that you'll see in the comment letter, there's operational information or financial details they may want some clarity on. What does this mean? Who did that? Why did this cost that much? Where did this money go? They may want you to explain different aspects of the business plan, especially if you have something something novel or unique you're doing. They may want you to expand on your risk factors. Maybe they think that there's other things that may be risky about your deal that ought to be disclosed to investors. So they'll ask you to add those things or change those things or enhance those things. They really don't like anything subjective or hyperbolic or salesy. So, if you've used terms like better, or safer, or this opportunity is a real gold mine, they're probably going to take issue with that and say, okay, you need to tone this language down, and you need to roll this, say something a little more factual instead of all this puffery. And then anything that's speculative about how your investment, promises high returns, or we expect that we'll get fast results from, maybe the regulators that are reviewing our drug or things that we're doing. So they really don't want those speculative things. And we had one we did where this was a drug company was making drugs that are for different types of inflammation, and they had done studies, and the studies, in rats showed, basically chemical A reduced inflammation more than chemical B. And so they said like chemical A was superior at reducing inflammation versus chemical B, which I didn't think was a controversial statement. I think it was very obvious from the data, but they even took issue with the word superior. I think the word was superior, maybe paraphrasing, but a word that meant superior, because it sounded like it was hype, even though the data was like, no, this really does reduce it more than that. So we had to say it reduces more rather than it's superior at reducing. So those are the kinds of comments you're going to see. So they're going to send you a letter. They're going to have all these comments or questions. They'll be numbered. You're going to write them back, or your attorney, more accurately, is going to write them back and respond to each of them, and is going to amend your offering circular to address whatever it is they wanted you to change. So sometimes you're just going to explain it in the letter. Sometimes you're actually going to update the document, and then you're going to resubmit it to Edgar. And then a couple weeks later, you're going to get another comment letter, and it's going to have a list of other things they want you to change. You're going to respond to that, and they're going to give you another. And so back and forth and back and forth, back and forth. Eventually, and hopefully you're whittling down the list. Eventually, they're going to run out of comments, and they're finally going to say, we're good. We don't have any more comments. And at that point, you can then request that they qualify your offering. And when they qualify it, that means you are able to go forth and actually start raising money. Call back all those people that expressed interest and say, hey, our deal's live. Here's the link to look at it. Do you want to invest? And when they say yes, you can actually take their money this time. Now, an important point is that, and people misuse the terms a lot just because they're speaking colloquially or whatever, but this is not registering an offering. We're submitting an offering to the SEC. The SEC is looking at it, but it's not registered. It's still an unregistered offering, still an exempt offering. And receiving qualification from the SEC is not receiving their approval. So in other words, when they give you comments, they're giving you disapproval, but they will never give you positive approval and say, yes, we approve of this. We we sign off on this. This is great. They're either going to say, here's the bad stuff, or they're not going to say anything. And they even require you to put a legend on the cover sheet of your 1A that says exactly that the SEC has not given its approval of this offering. And in fact, it ends with the commission has not made an independent determination that the securities offered are exempt from registration. So even though you've maybe spent months going back and forth over the nitty-gritty details of your offering with the SEC, they won't even tell you if you qualify for the Reg A exemption. You hope you do, but they're not going to tell you if you do. So qualification is not approval. So you're never going to say we got this approved by the SEC. No, you got it qualified, meaning they're not going to stop you at this point. Okay, so now that we've gotten qualified, now that we're out and we're pitching investors and we're raising money and everything's good, it's not over yet. We still have ongoing reporting that we have to do. And so you're going to be, while your offering is open, you're going to be submitting reports periodically to the SEC. One of them is your annual report. It's called the 1K, not to be confused with the K1, which is what you will give to your investors to show them what their portion of the tax burden of your offering is, at least if it's taxed as a partnership. 1K is or K1 is taxes. 1K is a securities filing with your annual report. In the 1K, you're going to update details of your offering circular. You're going to talk about how the business is doing. You're going to disclose any related party transactions. You're going to update the financials with more recent info. So new audited financials, again, more expense. There's also a semi-annual report you're going to do in between the annual reports, so 6 months apart. And that's going to have management's discussion of the financial condition. And it's also going to update the financials, although in the 1SA, they do not have to be audited. And then occasionally you're going to file what's called a 1U. And the 1U is just to announce significant happenings or material happenings at the company. So if there's a change in the business plan, a change in control, an officer, your CFO left and you got a new CFO, we're going to disclose that on the 1U. If you declare bankruptcy, if you get a new auditor, if you find a mistake in your offering, maybe something was stated wrong or there was a typo or something, you can correct errors in it. Does anything important that you need to report to the SEC is what's going to go in your 1U. So those are the basic reports. There's a few others. I'm not going to get into the details of it for our purposes here. And that is a 1A offering. And with that, I'm going to shift gears just a little bit. I'm going to bring on my partner, Nate Dodson, who is going to supplement the discussion a little bit with the discussion of real estate investment trusts. What's up?
How's it going, Richard? Thanks for the amazing information. Yeah, these are, you definitely undersold what you have accomplished and been accomplishing with getting these deals through the SEC, getting it through without them coming back saying, here's this dozen-page document with all these issues, problems, headaches, blah, blah, blah.
Did it once. Did it once.
And
maybe we'll be able to do it again. I hope we can do it again, but I'm not gonna. I'm hesitant to even take credit because they won't tell you why. And the letter it's actually funny. The letter they send you makes it sound like a bad thing. They're like, we're not going to review your offering. Yeah. It's like, it does a great job, or we didn't find any problem. Nothing like that. It's just like, we have chosen not to review this offering. And that's the letter's about this long. And just, you like, did I do something wrong? Like, I actually called the SEC attorney. I was like, is this right? Are you not gonna give us comments? And she's like, no, we're not gonna give you comments. Okay.
That just is one of those high five, move right along.
I mean, I'll take it. I'll take a win where I can get it, you know.
Well, it's a wonderful year, and so there's a start of some good wins and continuing on. And I did thank you so much for allowing me to have a little bit of time with your webinar. You know, it's really just kind of wanted to cover some of this, some great options, and well, talking about REIT, which is a real estate investment trust. The thing for people to understand is if you're looking at smaller funds, you're doing a smaller Reg D, this isn't the vehicle for you. That's why it really does tie well into the Regulation A, or frankly, public companies. You can invest in REIT through the New York Stock Exchange and other stock exchanges. However, really, you can also do it yourself. It really just has to make sense at the end of the day. And I'm going to see if I can figure out how to, there we go.
Cool.
So an
Hide my
important
face so I don't just sit here and nod at you.
that works too. Could you study up on your joke? Because there will be a joke quiz at the end of this.
I'll go look up some jokes right now.
I appreciate it. And then for everybody else, please, if you do have questions, as long as we do have time, throw them at us. And if you don't have time to answer any of them, we will have another kind of get together, answer all the questions that we didn't have the opportunity to, as well as another wonderful opportunity to talk to us, the team, and everybody else. And in any case, back to the REIT. A REIT, the real estate investment trust, is not a trust. It's a tax election. And I think that's the first step of what people truly don't understand about it. Is it's a great buzzword. Everybody's heard, I've invested in this REIT. I see billboards with REIT. Blackstone has a massive REIT raising billions of dollars. You know, it's actually a great tool to use, and you can make use of it if you're doing a Regulation A offering. You could do it with other different exemptions, or if you're looking to go public, you can do it that way as well. However, one of the weird things is a REIT requirement is actually that it's a corporation, or at least taxed as a C Corp, a corporation. But so with a REIT, you know, you do have to invest in real estate. It is, you don't do other businesses or equity investments. It truly is for real estate, where you are simply collecting rent or mortgages. Secured mortgages do apply for being qualified and considered a REIT. Collecting rent, collecting interest, renting out spaces, even if it's like a special event or more short-term rentals, that's perfectly fine. It is still rental income. And then, of course, getting the benefits from the upside on sale. All right, why do you really care? And why subject yourself to these limitations and restrictive what you can invest into or not? With a C corporation, they call it double taxation. And I'm sure most of you have heard about what double taxation means. Well, you invest in AT&T as a great example. You buy some shares, they send you a dividend. The AT&T, the corporation, actually pays taxes on its profits, and then the profits get sent to you as a dividend, and then you pay taxes on the dividends as well. That's why I call it a double taxation. The REIT election actually gets rid of that. Other kind of requirements of it is a REIT, the real estate investment trust, it's got to distribute almost all of the taxable income to the shareholder, but it can also deduct the dividends that are paid to the shareholder. What does that mean and what does it look like? Well, if the REIT makes $1 million, it distributes, required to distribute 900,000 of it, 90%. Most of them actually distribute 100% of the taxable income. So there is not so much the retained earnings that often, most corporations, they want to grow, they want to expand, and they retain earnings and they reinvest. Classic Berkshire Hathaway, massive company, has never issued a dividend. Why not? Well, they think that they can do a better job reinvesting the money than sending out a dividend to the shareholders, for the shareholders to decide where to reallocate their investment dollars. With a REIT, it is required that the investors receive their dividends, and then the shareholders pay the income tax on those dividends as well. And someday I will learn how to be better at this whole technology thing. So there are, like I said, a number of different requirements that go with the REIT tax election. And it's quite literally letting the IRS know that you are doing a REIT. And you do have intermittent tests to ensure that you meet the qualifications, and you have to maintain that on an ongoing basis. But basically, 75% of everything that gets invested into has to be real estate. Let's use a few examples of when this makes a whole lot of sense. If you are a mortgage pool and you are either originating or acquiring or wholesaling the real estate mortgages, those debts, that qualifies as long as you have at least 75% of those assets in there, with more than 75% of that income coming in through the mortgage interest or refinancing, sales of the properties, or of course rent. And then, as we talked about, at least 90% getting distributed to the shareholders. However, at the same time, that does limit the ability to, am I a little lost there? Hey, that works too. I knew I would figure out how to run a PowerPoint. So, okay, in terms of the requirements, I think I have it. Okay, here we go. All right. Requirements, like I was saying, it's an entity taxable as a corporation. It doesn't have to actually be a corporation. It could, in fact, be trust, an irrevocable trust can elect to be taxed as a C Corp. So in fact, a real estate investment trust can actually be a trust. Kind of very similar to, I'm sure a lot of people have heard about Delaware Statutory Trust, the DST. Really kind of a very similar concept. And we will talk a little bit more in a bit about how to contribute property for the interest, or how to participate in the 1031 exchanges to really benefit, kind of similar to how the DST works. Now, in terms of the management of a REIT, there's, of course, always the management of the REIT, the direct management. They're actually limited from being able to be the direct management of the properties as well, although they have some influence. The big issue, the big decisions are made by a board of directors or a board of trustees. Now, that is an absolute requirement if a REIT is getting publicly traded. You can do away with this requirement if you remain private and you're not looking to be on a stock exchange. I would suggest a great course of action is to actually include a board of directors or an advisory board or something to help with the decision-making process for yourselves. It really can limit your liability or limit the angry investor issue if a wrong investment into a not good property occurs. Having a lot of minds making these decisions can really help with an individual issuer's liability with that. Now, there is also a requirement that you have at least 100 shareholders, 100 investors. What does that really mean, though? Hey, you set one up, you don't have 100 investors. You actually don't have any investors. That's okay. It is a requirement of within that first year, you get 100 investors. If you fail to accomplish that, you can lose your REIT election. And with that, you're stuck with the double taxation issues all over again, as well as, again, angry shareholders that are not getting what they expected to invest in. So it's great for the Regulation A because you have so many different investors, oftentimes smaller investors. But it is simpler to hit that 100 shareholders when you can sell the investment, sell the stock or membership interest or trust interest to really everybody. And then the last big requirement is that it goes kind of along with the same 100 shareholders. The REIT election is meant to be helpful for absolutely everybody. And so they do want at least 50% to be owned by more than 5 shareholders. So you shouldn't end up in the situation where the top 5 guys, the guys that organized it, really own 75% of the company and only 25% of it gets sold to the shareholders. They can't be set up that way. All right, now kind of the upside. What's the benefit? Why even deal with this stuff? To start with, we've got that double taxation. The C Corp paying the taxes, making dividends, and then the shareholders paying dividends, that just goes away. It actually operates more like a partnership taxation, but not necessarily. It isn't a pass-through like if you had invested through an LLC with partnership taxation or a limited partnership where the profits and losses and everything flows down. That's not applying here. In this case, the investors receive a 1099 for whatever money that they receive. And that's it. What happens with the losses or the depreciation, it stays with the company and it affects the amount of taxable income there actually is. So your depreciation will reduce the taxable income. And you're required to distribute at least 90% of that taxable income. So that will make things a little bit easier. You don't have to, you're not required to distribute quite as much. But you could end up distributing more than the taxable income that the corporation shows. And that's fine because the profits still get taxed 1099 to the investors. And so it is very similar to, like I would say, a partnership taxation process. However, way simpler. It does need to ensure that the REIT qualifications are maintained, but from the shareholders' perspective, how much did you send to them? I'm well aware, as I'm sure you are, that from the investor standpoint, one of their biggest pet peeves are the K1s. Where's my K1? Let me call you another 10 times this week. I really want to file my taxes. Where's my K1? In this case, there is no K1. There is the 1099. It's a much simpler tax preparation for the investors process. How much money did they get? They get their 1099 dividends based on that. Much easier. So, few other of those benefits. Really, you're playing with the big boys. There we go. There generally, REITs are for publicly traded companies or really kind of massive pools. You can have a Reg D, a truly private placement REIT. However, generally it's tough to make it work because you need to have those 100 investors, and it needs to be large enough that you can acquire the cash flowing property. This isn't for ground up construction. This is for income producing. If you're trying to put together a multifamily fund and have a bunch of happy investors because of how much of the earnings, the taxable income has to be distributed, a REIT is a great way to go. Not as great if you are doing it under Reg D, just because of the qualification requirement. But because these are bigger deals, it is much easier to acquire multiple assets and to have more of that diversified portfolio. And to talk a little bit about when it gets kind of exciting, and I apologize, it's taking a little longer to get through it all than anticipated, so I'll burn through this, but do want to give you this information because this is where it gets to be huge. The UPREIT. UPREIT, Umbrella Partnership Real Estate Investment Trust. I think it's kind of comical that we have partnership in there and trust, but really it still has to be a corporation. They call it this UPREIT because so it can take advantage of it's section 721 of the Internal Revenue Code, and it ties in with the 1031 exchange. Going kind of through the experiences and the past deals, hundreds of them over the years, and trying to get these 1031 exchange investments to work with the acquisitions and the process, it's always been difficult. Now, with the UPREIT, with the REIT, if there's a 1031 exchange goes into a property, the property can be contributed to the REIT without recognizing a capital event, capital gain. So it still is a property transfer, and it's not a 1031 exchange, but it is a 721 contribution. The property itself gets contributed to the REIT. The REIT issues units. And I think I even have a pretty picture all about it. Yeah. So there you go. So the investment property gets contributed to the REIT. The REIT then issues the shares to the shareholders, and it's a tax-free contribution, meaning you're maintaining the same tax base. And everybody's been trying to figure out, hey, how do I send the property over? How do I have this 1031 investor? And I just want to give them units in my fund. I want to have them as part of the syndication. This section 721 is actually the way to accomplish it and to do it. So it is a great vehicle. And so if you set up your REIT to allow for these contributions to be made with the actual real property, perfectly acceptable. The investors contribute the property to the REIT. The REIT issues the shares. Investor is now a shareholder, period. Now, the downside is you can't 1031 exchange, but from company interest to company interest. So the final investment to do the 1031 exchange, property after property after property. It ends as soon as the election for 721 contribution occurs. However, the REIT can still do 1031 exchanges. It really just doesn't flow back to the investor. And because it does destroy the kind of the ongoing 1031 exchange, it is advisable for the property owner to not be within that 1031 exchange test time period to contribute it back, at a risk of the IRS ultimately saying that the 1031 exchange, the original one, is not problematic. It's not a REIT issue. The REIT doesn't care, but it would be an investor issue, and we all care about our investors. So I do want to thank y'all so much for taking the time to join, and I apologize that I've just kind of taken up the remainder of the time. I did want to give you the additional information on REIT. If you had some questions or comments, please email me directly, or Richard if it's the Regulation A. I gotta say, he's my partner because he's a genius, hands down. He may be a hippie, but he is a hippie genius. And so when it comes to the Reg A's and getting those launched, he's definitely the man for that. Everybody else, look forward to meeting and talking. Please send any of your questions our direction. The Q&A questions that we do have some, we'll answer next week. We'll get it all arranged. So please come back, and rather than say, hey, can you send us a video? Just join our YouTube. It will be up there, not right away, but we'll get this all up there, and look forward to talking to you soon.